Hello and welcome everyone to this webinar recording of our series on a sustainable recovery. In this final session, Oshani Perera, the former director of IISD's infrastructure program, speaks to a very distinguished guest, Dr. Joseph Mariathasan. Their conversation focuses on quantitative impact measurement and ESG reporting of companies. Joseph Mariathasan is a contributing editor of Investments in Pension Europe magazine and director at GIST Advisory. GIST is a global initiative for a sustainable tomorrow, which is an international sustainability analytics, solutions, and insights firm. In this conversation with Oshani Perera, he speaks about the importance to assess companies not only based on their financial performance, but also based on their positive and negative impacts on the environment and society. He explains how GIST provides analytics and intelligence by quantifying and monetizing the negative and positive externalities caused by companies, categorized into natural capital, human capital, social capital, and financial value addition. GIST has conducted such assessments for thousands of listed and unlisted companies and created various company and sectoral indices. This area of their work has triggered much attention by asset owners, such as pension funds, endowments, and sovereign wealth funds that are interested in ESG impact measurement and ESG reporting of companies. But indeed, such insights are not only of value to asset owners and potential private investors, but could also be insightful for policymakers and public sector decision makers that design public spending programs and recovery measures in light of the ongoing COVID-19 pandemic that affects many private industries heavily. Thank you for your interest and now enjoy the conversation.
Hello and welcome everybody to this final interview in the series of the Sustainable Recovery. We are the International Institute for Sustainable Development, and I'm Oshani Perera. I lead the work on infrastructure. And today I am delighted to be talking to Joseph Mariathasan. He is a fellow Sri Lankan like me, so that is fantastic. Welcome, Joseph. You are the contributing editor to Investment and Pensions Europe, and you're also a director at GIST Advisory, which is the global initiative for a sustainable tomorrow that's based in Switzerland. And you have many other very interesting experiences across your career, and today hopefully we'll hear about some of them. And to put our readers, or our listeners rather, into the picture, we are in September, coming into the fall, and the pandemic in Europe at least is raging. We have the European Central Bank a little bit worried about sustaining the stimulus and for how long they can sustain the stimulus. We have citizens on the streets protesting against the second wave of lockdown and even protesting about wearing masks. And then we have the general feeling of anxiety, not understanding when there will be a vaccine and for what kind of COVID-19 situation the vaccine will provide a solution. And then we have a general understanding that yes, if we don't look after nature, this is just the first of a sign of economic shocks that we are going to have and that we don't know how to deal with. And that is the crux of the matter. And that is what Joseph and I will be talking about today. We have finally understood, or have we finally understood, that nature needs stewarding, and if we don't steward nature, our whole economic and social systems will collapse. We are all aware of the zoonic risks that COVID-19 has brought to bear. What else is in store? And in this setting, Joseph wrote a fantastic article in March this year. And if you haven't read it, do look it up. It's on Investor and Pensions Europe, talking about externalities, that nature is not valued in our economic systems today. And because it's not valued, or it doesn't have a place, it's considered a public good. And because it's a public good, it's free. and it becomes an externality at the peril of the very asset that we are trying to value. Joseph, would you like to elaborate about this a little bit, please, and share some examples on the work you've been doing to value externalities?
Sure. I was trained as a physicist, so I did a doctorate in physics. And so I've moved into economics really along my career as I sort of moved into finance. And what I always find amusing about economists is that they have what a lot of physicists call physics envy. In other words, economics is trying to put a mathematical formulation into its theory to actually try and emulate the grand theories of physics, the of general relativity, quantum mechanics, and so on. And the idea that economics has been trying to put forward is that it is a science. But actually, economics is really the study of human behavior. It's a study of human behavior on a mass scale. And therefore, it is not really an experimental science. So the problem with economic theory is that it's an approximation. It's an idealized approximation to a mathematical model, which is an idealized approximation to how they think human beings behave. But the problem is, human beings don't behave according to theory. People behave driven by things that aren't profit maximizing ideas. So we are willing to forego consumption to benefit our grandchildren. But that's not really taken account of in economics. Conversely, there can be negative incentives that drive people if the regulatory environment is put forward. And a clear example of that is the whole idea of shareholder maximization. Milton Friedman, who's a Nobel Prize winner in economics, wrote a very influential paper in the article, actually, in the New York Times in 1970, where he explicitly said the fundamental objective of corporate management should be to maximize profits for shareholders. And then he actually said, if that means they are spending more on pollution control than they are legally obliged to do so, they are acting against the interests of shareholders. Mm-hmm. And that's a very powerful statement, because what he's actually saying is that it's up to governments to set the regulatory environment and to control the way corporations operate. And within those rules that a government sets, corporations should do whatever they can to maximize profits. And that means that they can actually, how shall I put it, destroy the public goods if they're allowed to, if it maximizes profits for shareholders. And that, in effect, has been the driving philosophy for the last 50 years. And what that means is that whatever isn't accounted for as a cost to a company is therefore able to be exploited. And that means that companies can, if you're a mining company, you can produce tailings waste that isn't actually accounted for if there's no legal obligation to do so. And so therefore what you get is a phenomenon of public losses and private gains. So shareholders can benefit from, for example, at the extreme end, you could imagine someone chops down or burns the Amazon rainforest and sticks a cattle ranch there. The owners of the cattle ranch can generate huge profits because the government has sold them land, but the public good has been devalued by the loss of that Amazonian forest. But as far as the shareholders are concerned, that is perfectly legal because they've operated within the law. And so the real problem with particularly the current economic system is that we have this system that all externalities are not priced into the profit and loss of a company. And what that means is that companies are behaving in ways that are not necessarily good for society, but are certainly good for their shareholders. And so what we do at GIST is something that is actually becoming incredibly popular now, which is the idea that companies should be assessed not only on their financial profits, but also on the total impact that they actually generate in the world. And there are lots of ways of actually classifying impacts. And if I can just share the screen, I'll show you a couple of a couple of pictures and so on, and we can talk around that. But just to give you a bit of background, people talk about the UN Social Development Goals. They talk about the EU is now putting forward a regulatory framework. There are other economists who have come around with the idea of talking about so-called 4 capitals and 6 capitals. They all are based on the idea that if you look at the fundamental elements of a company, an asset that's operating in a certain place, a factory that's operating in a certain place, it is possible to not only look at the financial profits and losses of that factory, but also look at its impact in terms of what it's doing in terms of pollution, what it's doing in terms of creating employment, what it's doing in terms of adding social value. So let me just share a screen. I'll tell you what I mean. An externality is essentially the idea that if you're a factory, supposing you're a cement factory, and I'll tell you why I've chosen that example, you may be producing lots of profit, but at the same time, you're producing a load of pollution from your chimney, and that pollution is blown around by the wind, and it lands in people's dwellings, and it causes respiratory problems, and those respiratory problems give rise to illnesses, and then people either fall very ill, or in extreme cases, it leads to mortality. And so the profit, the shareholders have benefited from selling cement, but at the same time, society has actually lost a fair amount. Now, the question is, what's the relative amount of what's been lost and what's been gained? And that is really what we do at GIST. We actually calculate the impact. And let me just tell you about impact and the way of looking at impact. And really, this is the IFC actually came up with analysis. And there's really three routes to looking at impacts of corporations and so on. Well, one is what they call targeting, which is really you just invest in a company that is seen to be good. You know, it's a water company, or it engages in something that produces some value that is immediately obvious. And therefore, that's the basis of sort of impact funds and so on. What we're seeing mainly these days is ratings, so ESG ratings, and there's probably 600 different rating agencies, and they all, in their own way, try and do a good job. But what they're all doing is giving subjective figures to 50 or more different criteria. You know, how much pollution does this firm produce compared to its peers? Let's give a mark out of 10. What's its corporate governance like? Let's give a mark out of 10, and so on. You go down 50 different criteria, you give marks out of 10 for each one, and then you average them, and you get an ESG rating. The problem with that is that as those figures are subjective, each rating agency has a different focus. And therefore, when you look at the ratings of different agencies for the same portfolio, they show almost a zero correlation. And there's actually lots of work being done by different entities, including a famous chart by the Japanese Sovereign Wealth Fund, the GPIF, where they actually looked at 450 Japanese companies that were rated both by MSCI and FTSE. And both are very, very credible agencies. But when you plot the ratings of one against the other, it is a complete scatter plot. And that is the fundamental problem, that when you look at ratings, they are subjective, and therefore they have some value in helping an investor to think about what they should be doing, but they aren't an objective measure. The third approach, which is really what we do, is what we call, which is what the IFC calls monetization. In other words, try and put a value, a scientific or an economic value, to externalities or the impact of firms. And that is what we do. And the way to do it, look at it, is, let me just take a next. As I said, you can look at impact in lots of different ways. And the way we look at impact is, an impact is a change in human well-being. And that's a thought we have to say. And you can measure that change in well-being in a lot of different ways. One, what's getting very popular these days is the UN Social Development Goals. They have certain, they are popular. They're not necessarily that rigorous. And so the area that we started from, and I'll move on to UN Social Development Goals because we actually do map our figures onto those. But we start off looking at the underlying assets, and we divide the impact into 4 capitals, which really covers the total impact a firm makes. And the 4 capitals, and this is a straightforward academic theory. There are a lot of academics who produce a background to this. Some people use 6 capitals, some people use 4 capitals, or you can mix and match, and it's just a question of mapping the underlying figures. But if you look at the 4 capitals, and the first is environmental capital, natural capital, and which is effectively the impact on nature, whether it's a rainforest or whatever. The second impact is what we call human capital, which is that if a firm employs people, it's giving them wages, it's training them, it's giving them health benefits and so on. So there's a benefit to the employees by working for a firm. The third area is what we call social capital, which is really something you can't necessarily measure so easily, but it's a glue that keeps society together. And it effectively means what firms are doing in the area of social good. It could be that they have some form of program to benefit the population near their factories or so on. There's a whole range of things. And finally, there's a conventional financial capital, but that's not just a profit. It's also the taxes paid by the company to the government. It's the capital expenditure paid by the company to other companies, and so on. So these are the 4 capitals. Now, we actually have a team we have 50 people within the firm, of whom about half are scientists and engineers. Most of them actually from the Indian Institute of Technology, which is the premier Indian engineering institutes. Right. And so they actually apply scientific rigor to the calculation of impact across all 4. Although financial is obviously, you just read off the enough databases with financial information. But let me give you an example of environmental impact. And let's take the case of air pollution. A cement factory in a location produces a lot of pollution, probably 50 or 60 different pollutants. How would you put a monetary figure to the value of those pollutants hitting local populations? Well, first of all, you need to know where the chimney is located. And so here's this really little red dot, which I can sort of highlighting here, which hopefully you can see. Yes. It's actually the physical location of a chimney. Right. And to know where what's happening to the pollutants, you need to know where the wind is blowing. Right. And we actually use the NASA database of global wind speeds. Okay. Where we have taken data from NASA, and we have actually divided the whole world into 50-kilometer grids. And the data actually comes much finer than that, but then it takes weeks to analyze. 50 kilometers is about a decent size. And then for each pollutant, we know the mathematical equations that determine where they fall given wind speeds and so on, wind heights. And so you can produce this dispersion curve, and you can see that map there is actually the concentration of pollutants given the wind speeds for that particular area through the year. Once we know where the pollutants land, we can then work out how many human beings have been impacted, because we also have databases of population densities down to 1 kilometer from the United Nations. And so we know how many people have been impacted by those pollutants. And then to calculate the impact on human health, we know from the WHO statistics and databases what the impact of each of those pollutants, and they could be 50 or 60, are on human morbidity, in other words, ill health, and human mortality. And so knowing that, we can then work out the loss in earnings for that family because of illnesses caused by those pollutants. They're usually respiratory illnesses of different sorts, which cause people on average to lose a certain number of days or weeks work, and in certain cases could even cause mortality. And we're not trying to put a price on human life. What we're trying to do is work out the loss in earnings to the family.
Right.
That then gives a value for impact of that air pollution. Now, just imagine we can do this for all the impacts of a company.
Right.
And we've actually done this now for thousands of companies, both listed and unlisted. And let me just show what that means then. Because what that means is we've currently finished the impact for about 3,000 listed companies, including every single company in the major MSCI Developed Market Global Index.
Right.
And so what we can tell you is that if we know the market cap, the size of the company, and the amount of impact in monetary terms, we can tell you for each $1 million invested in that company, how much impact, and these are all negative impacts the companies tend to have, that company has on the world. So we can say to a pension fund or to an investor, if you invest $1 million in this company, it will cause this amount of negative impact per year. And over here, what this chart shows is just a sample of 100 companies. This was done many, many months ago. And what it shows is that on the left-hand side, this is a logarithmic scale, so it goes up by a factor of 10 for each band. On the left, you see a firm called Santon Pharmaceutical, which is a pharmaceutical company, which actually, for each $1 million invested in that company, produces a negative impact per year of only $1 or $2.
Right.
On the right-hand side, we have an industrial company called ThyssenKrupp. And for each $1 million invested in that company, it produces something like $500,000 of negative impact on the world per year.
Right.
And so you can also do that by looking at different sectors. So within the sector, you can compare companies. We can compare companies, and we can say within a sector, it could be the energy sector or the auto sector, this company, each $1 million you invest, actually produces a much worse negative impact than another company in the same sector. And that could be for all sorts of reasons, you know, the way its operations are organized and so on. And in the case of cement factories, for example, it's often because of their location. So a cement factory that's located near a city will cause far more negative human impact than a cement factory in the middle of nowhere. And certainly also when it comes to water consumption, because that's another key issue when it relates to human well-being. You know, water scarcity. It's no point in just measuring the amount of water a company uses, because the actual value of that water to human beings varies dependent on location. And so therefore, that's why we feel you need to put a monetary value, because if you put a cement factory in a area of water scarcity, it causes far more negative impact than cement factory in an area of water plenty. And so that's the sort of key aspect. And so what we would say, and in fact, a lot of people, including some very well-known economists like the private equity investors like Ronald Cohen, is talking about impact. You know, I'll just show you. Ronald Cohen has written a book called Impact: Reshaping Capitalism to Drive Real Change.
Right.
You know, investors have always looked at investing as a combination of looking at the return of a company and the risk. And there's a whole branch of economics called modern portfolio theory, which was invented by a person I actually know very well. I went to a joint venture with him called Harry Markowitz, who's the Nobel Prize winner. And the idea of modern portfolio theory is that you actually have to diversify your assets, because you can then maximize the return for a given level of risk. So the idea is that if you had an ice cream factory and an umbrella firm both giving the same profits per year, and you invested 50% of your investment in the ice cream factory and 50% in the umbrella factory, you wouldn't change your overall profit in the year, but you would change the volatility, the daily profits, because on whether it's sunny or rainy, you will get profits from one of the two firms.
Right.
So the daily, but what we would say is, let me share the screen again and show you. What we would say is what also matters now is not only the risk and return, but also the impact of an investment on the world.
Right.
So the impact per $1 million invested in that firm actually matters.
Right.
So if you're a portfolio investor, what we could say is, and let me just show this as a sort of illustration. We can actually say, we can actually produce the equivalent of the efficient frontier that was mentioned in the Nobel Prize winning work of Harry Markowitz, where he talked about risk and return, to say, why don't we have an efficient frontier of impact and risk?
Right.
So we could say there is a single stock in a portfolio that will have the maximum impact per $1 million invested, the maximum positive impact, I mean. Or
right. Yes.
So it could be a forestry company so you put all your money into that company, you will get a large positive impact for the world. But the only problem is that it will be highly risky, because depending on what the circumstances are, it will actually change its profitability and so on. Therefore, adding more stocks to your portfolio will reduce the risk, but it will also reduce the impact per $1 million that you invest. But there is a portfolio of stocks that you can produce that will produce a maximum positive impact per measure of risk, which is what we have here. And here you can put absolute risk in terms of how volatile something is during the year, or compared against a benchmark and so on. But these sort of figures can also be looked at in terms of the UN Social Development Goals. So if we take the cement factory example, and we look at its impact in terms of natural capital, in social capital, human capital, financial capital, we can map those onto the 17 UN Social Development Goals.
Right.
What that means is we can, for example, take a company, and this is just a random company I happen to have a chart for, Bombardier.
Yes.
We can see that these are the 4 capitals. We haven't bothered putting the social capital because we can't calculate the social capital for a company. We can see the financial capital is very high.
Yes.
Which is what you'd expect because it's a profitable company.
Right.
It's got a very high, a reasonably good level for human capital because it employs lots of people and so on. But it produces a fair amount of negative externalities in the form of natural capital.
Right.
And we can then delve into where those negative figures come from, but it could be from a whole range of things. They could be causing pollution in some of their factories and so on. But we can also map these figures onto the UN Social Development Goals.
Right. And
so we can see that there's a very huge positive figure that amounts to its effect on the economy, because it's actually obviously producing lots of profits, but then there's lots of negative impacts in terms of these sort of figures on the other UN SDGs. And so the net outcome of all this is that, as Ronald Cohen was saying in the book that he's just published, and as we would say, and as many others would say now, that look, economics and finance have got to move away from the idea that maximizing shareholder profits by creating private profits combined with public losses is no longer acceptable. And therefore, everything needs to be measured and accounted for. The first step before accounting for these within a company's P&L is to actually be able to measure them.
Right.
And that's what we do. Now, the next step ultimately would be to charge a company for negative externalities, because for a company to be sustainable, ultimately, it's got to be producing positive figures for all of these things. It's got to be seen for it to be able to survive, it's got to be obviously produce positive financial capital. But we would argue that for a company to be sustainable, it's got to actually not produce negative figures for the environment. So the natural capital figure should also be positive. But in actual fact, most companies are producing negative natural capital figures because they are producing pollution, or they are, in some cases, in some mining companies' cases, the impact of the pollution caused by tailings, it's not so much greenhouse gases, but waste disposal, far outweighs even the financial profits.
Indeed. And what has been the reaction of some of the companies when you showed them the negative values? Certainly at IISD, when we have done this, using the sustainable asset valuation, the reaction hasn't been very positive at all. They just don't want to engage.
Yeah, let me sort of address that in another way. We have two businesses at GIST. GIST started off doing work for corporations.
Right.
And corporations that GIST did work for tended to be things like the Yarra Water Company, and a Swedish forestry company, which are actually some of the few companies that actually produce positive externalities when it comes to capital. So they are obviously delighted to hire us to analyze them, because they come out looking very well.
Right.
Most of the other business that GIST has is working for the investor ecosystem, as I call it. In other words, for asset owners in the form of pension funds, endowments, sovereign wealth funds, and so on, and fund managers. And there we see a tidal wave of interest, literally a tsunami of interest in the whole idea of ESG reporting and impact reporting. And we are able, and we are probably at the cutting edge of what is possible to do in terms of actually producing monetary figures for impacts. And so we are very busy satisfying those. Where we are not working dramatically or overloaded with work is our mining companies or whoever asking us to calculate the impact of their activities. And you're right, the problem is that it is hard for an industrial company, or in fact most companies, to say, why don't we hire a firm to tell us how bad we are in terms of our impacts. Yet that needs to be done, because unless you do that analysis, you can't move to a better position. It's only by understanding and undertaking that analysis that we can actually work out what the firm could do. And that's the sort of frustration that ultimately companies can improve. And I'm very confident that the way the world is moving, there is such demand by the population as well. Ultimately, this move towards sustainability is being driven by individuals having the view that the world needs to be sustainable. And to be honest, it's being driven more by the younger generation. My daughter's 24, and her generation are all keen on, when they make investments, they want to make ethical investments. They see impact as important as return. That's a wonderful thing to see. And as a result, what's happened probably in the last 3 to 4 years, and no more than that really, has been the asset owners, the pension funds and endowments, are now making a huge push, a huge impetus to actually take sustainability seriously. And as a result, they're pressurizing their fund managers to take sustainability seriously. And the fund managers themselves are then pressurizing the corporations.
And going back to 2 points that you brought up earlier, Joseph. The first one is this cataplot between two ESG ratings or on the same portfolio or the same company. Do you see increased sophistication in these ESG ratings, however? You know, is there increase, are there more, do you see a trend that they're really built on good data, on good science? Are they listening to people like you?
Well, I think some entities are. I think the fundamental problem with a rating, I'm not saying ratings are bad. I mean, look, don't get me wrong, I'm not trying to say that ratings shouldn't be looked at.
Understood.
And many fund managers find the ratings useful, not so much because they're being told this has got an average score of 40 versus 53.
Yes.
It's actually the analysis that goes into that rating. So if you hire a rating agency, I won't mention any names, but if you hire any particular rating agency and you have access to the underlying steps that lead to rating,
Right.
that itself produces useful information.
Absolutely.
The problem, though, is that a lot of that information is qualitative, and therefore it relies on a judgment. So if you take corporate governance, for example, and that judgment is, should there be a separation of duties between, I don't know, the chairman and the chief executive?
Exactly.
Well, that's a sort of qualitative view, and in some companies it may be a good idea, in other companies it may not be. But
Right.
trying to put a score on that, it just introduces an element of noise. And so what we would say is that, look, fine, we are more akin to an accounting firm. So if you're a bond analyst and you're giving a rating to a bond, the first thing you do is that you look at the balance sheet of the company, and then you look at its prospect and all sorts of things, and then you give it a AA or a triple B or whatever, and that's the bond rating. What
Right.
we are is equivalent to an accounting firm. In fact, what we do are essentially additions to accounting statements. We are producing figures that a rating agency or a rating analyst within a fund manager could take and add to other analysis and say, okay, I'd therefore like to give this firm a rating of whatever rating they want. So we see ourselves much more as the equivalent of an accounting firm or some other professional analytical firm that's producing numbers. So we have no view on the rating of a company.
Indeed. Point taken, Joseph. Thank you for that. And another point that you were talking about is stakeholder value and shareholder value. We've been told since the 70s that there are firms that take stakeholder value to heart more than shareholder value will succeed through all crises. Today, we have pundits on every single television channel talking about collective capitalism. And my question is this: in the transition towards a zero net carbon, in the transition towards sustainability, surely all stakeholders won't win. Large portions of the stakeholders will have to lose. We can't keep everybody happy all the time, as Winston Churchill said. Thoughts on this?
Well, that's true for any change, though. Any change will always give rise to winners and losers. And so if you're the chief executive of a mining company who's now having to take account of the pollution caused by tailings, you may well find your bonuses have been reduced. But I don't see any issue with that. The point is really that can we produce a sustainable form of capitalism that enables our grandchildren to survive in a pleasant world? And I think that objective is the way to look at it. Well, what is the goal of what we're trying to do? The goal of what we're trying to do is to ensure that our grandchildren can actually enjoy the sort of lifestyles that we live in, a world that is actually worth living in. And that is such a powerful message. And it's very difficult for classical economics to really deal with that idea, because we're prepared to do things that we see no immediate benefit to ourselves.
Right.
And that idea is really, I'm not too sure. I mean, I'm not a classically trained economist, so I feel rather reluctant to criticize economists too much. But it does strike me that a lot of the ideas behind classical economics don't really work when you start looking at timescales that are of the order of 3 or 4 generations. So even the idea of risk-free rates, you discount everything back to today's value. Well, the problem is, how does that work if you're talking about a forest that's going to be around for the next 1,000 years?
Exactly.
And will actually, whatever discount rate you use, whatever positive discount rate you use to value that forest will mean that it's valued less to your grandchildren than it has value to you today.
Absolutely.
And so there is a fundamental problem in taking this idea that economics is a science and trying to then analyze it in the way that a physicist, like I did in my previous career as a physicist, you take the fundamental ideas of physics and you can take a new problem and you know that if you apply them, you will get an answer that will be true. And that's what engineering is. Engineering is taking physics and applying it to a problem, and out comes the answer and you know it works. Try doing that with economics and it won't work, because the fundamental principles are not immutable. They are not like the laws of physics, and therefore they are just approximations, and they break down as soon as you come into an idea like sustainability. What does that mean for an economist? Funny enough, Adam Smith, who's often seen as a founder of modern economics, and he wrote the Wealth of Nations, which talk about the invisible hand and how markets behave and so on.
Yes.
Also wrote a separate book called On Moral Philosophy, where he actually emphasized the importance of society and,
Right.
and of companies and people behaving and working within society. And I think that's what's been left out, or that's what's missing in the idea of the ideas of Milton Friedman and so on, that ultimately, and the funny thing is, the most amusing thing in many ways, though rather sad, is the COVID crisis has shown that companies are not independent economic entities that can maximize profits and forget about everyone else, because they're all begging the governments to come along and support them.
Indeed.
And so post-COVID, we can see that, look, the companies have actually forced or begged governments to support them, both in furloughing staff, in terms of giving them direct grants and so on. Post-COVID, they have to now agree to actually behave in a slightly different way that actually benefits the rest of society, because the rest of society have had to finance them. Our taxes have had to go off and help support a load of companies. Now, once COVID is over, I think it's clear that those companies do actually operate within a society, and therefore they have obligations beyond what may be the narrower legal obligations to ensure that they operate in a sustainable manner.
That is a fantastic thought to hold in mind, Joseph. Thank you. They do have obligations, and hopefully the EU Farm to Fork strategy, the UK Agriculture Bill, that talks about public goods for public services, where subsidies and direct payments will actually be tied to the delivery of ecosystem services would prevail. Yesterday, we heard about the carbon removal certification scheme that's been promoted under the EU Climate Bill, where agriculture and agroforestry would also be asked to contribute towards carbon sequestration. Joseph, thank you for your time and your insights. It has really been an honor to speaking to you. I love your writing. I shall continue to be an avid reader, and hopefully in the months to come, IISD and Jess could begin a conversation and talk about our different methods of putting a dollar value on externalities more concretely. Thank you so much for your time.
Thank you for inviting me, and of course we'd be delighted to engage in dialogue with you. Thank you.
Thank you.